Hi, everyone. Thanks for tuning in to Groundbreakers. On this podcast, we interview early stage founders and real estate investors to hear their stories that will let them have success in their career and their journey from 0 to 1. I'm joined today by Mitchell Rice, founder of Elkstone Capital Partners. Mitch has been involved in over $500 million in real estate transactions across 10 plus states with an underwriting background that spans over $10 billion in deal volume. His firm focuses on helping investors preserve and grow their wealth through passive investments in commercial real estate. Today, we're going to dive into his journey from his career in finance to becoming a full-time real estate investor and what makes commercial real estate such a powerful asset class. Thank you so much for joining us, Mitch. Very excited to have you on the show.
Yeah, thanks for the opportunity. Happy to be here.
Absolutely. So to kick things off, you're now investing in real estate deals full-time. Walk us through what your career journey was like. How did you get here? What even got you interested in real estate in the first place?
Yeah, so I went the corporate route. So I went to school here in Utah at BYU, and one day I was looking for the investment banking club, and I accidentally went to the real estate club. And I was like, "Oh, real estate's cool. I'll just hang out here." So I stayed at the meeting, but I just remember being so confused because at that time, real estate in my mind were homes, it was single family rental properties. So I was like, "What are these guys talking about?" And so I kept coming back, like trying to understand it, and then I realized that every building you see when you drive down the road is commercial real estate, and it has shareholders, it has investors, there's somebody managing it, and it's just a massive global industry. And so I kept going back to the club week after week, and also my dad was a limited partner. He invested in a couple of hotel deals, acquired a couple of single family homes, and he and I together, we even developed our own self-storage shop up in Idaho. But yeah, just over the years, I realized commercial real estate kind of fit my skill set, and it was really fun. And I loved the thrill of finding a deal, putting it under contract, underwriting it, doing the due diligence, closing, managing. It just seemed like a really fun process that was repeatable. And there's so much variety and there's different markets. And it was something for me that I didn't think would get old. And so I just went all in on creating a skill set around commercial real estate.
Yeah, it makes sense. That's hilarious that it was because you ended up in the wrong club.
I know. Yeah.
So
I'm so glad I didn't go to investment banking.
Yeah. But you did start off in the corporate world. I know you mentioned you were in like real estate private equity prior to launching your own fund. So can you kind of walk us through, some of the deals you were doing there, or maybe, what you learned?
Yeah, I remember I was to get myself through school. I was in sales. So every summer I would go out of state and I would knock doors. And at the time I was making really good money. My last month ever doing it, I made about 50 grand. And then, so that was May of 2021. And the next month I was at a desk working at a local developer here in Utah for free as an intern. So that's how I broke into it. The classic work for free story. And I was working for a fund that was doing extended stay hotel to multifamily conversions. So that's really where I cut my teeth, learned how to underwrite. And thank goodness those guys were patient with me because I didn't know Excel at all, but they still gave me a chance. But I showed that I was determined and I figured it out. And after school, I landed with the for-profit real estate investment arm of the church, so Jesus Christ of Latter-day Saints. So I'm sure you've heard of the LDS Church or the Mormon Church. So they actually have a private for-profit real estate investment arm. And I was a development analyst on their development team. So we were doing big box warehouses for the Amazons and Walmarts of the world, 300 plus townhome communities. We were doing mixed use multifamily and retail. And then they have a sizable office portfolio, and the acquisitions team, which I was not a part of. They even purchased some hotels during COVID. So we were seeing all the food groups and working on really big deals, typically $100 million plus.
That's nuts. I didn't know they had a for-profit that did real estate investing.
Yeah,
that's a little known fact.
Yep.
Were you very focused on certain geographies at the time, or do they take a pretty national view?
So on the development team, wherever they own land, which isn't every market, like they own land heavily in the Mountain West. They own a lot of land in Florida. And, they'll just sit on land for 50 to 100 years until it falls into urban sprawl, and then they'll sell it off to another developer, or we get to cherry pick it when I was on the team. to do our own developments. So, but the acquisitions team was typically looking in different markets where the development team didn't have land, to diversify the portfolio and the markets we were investing in.
Got it. For the folks that, didn't have the opportunity to be, in a private equity like role and doing that level of transactions, like any big learnings you had from that experience or folks listening in that you can be like, hey, like this was really helpful. You should know this.
It was a totally different ballgame than what I'm doing now. We were doing Class A core. We were okay with lower returns because of that. And we were also future proofing everything because their thesis is hold forever. And so, if Class A was here, we were doing projects here, at that spec level. And I think investors just need to recognize that you're not going to get an 18% IRR on a brand new, sexy multifamily building. And especially if you're not levered. Like most of the deals we do there were all cash. And so the returns were much lower than what you would see in typical value add for Class C or Class B. And continuing to answer your question, it was cool just seeing like more professional processes and systems. For example, speaking Spanish. I speak Spanish. I spent some time in South America. For example, Argus. I don't know if you've heard of Argus. It's a underwriting software, but a lot of the big funds like the Blackstones of the world use it. And it was cool getting that experience because someday if I ever get into doing like really massive deals, brokers will send an OM and a package. And with that, they'll already have an Argus file for you with their underwriting. And so just that's an example of kind of the experience I got in more corporate real estate private equity. And also like one of the biggest things was investment committees on Friday. Like it's daunting walking into a big boardroom and there's 20 people at the table and you've got to present your thesis and your underwriting, and like nothing is more scary than that. So that prepared me to raise capital from private investors.
Got it. No, appreciate you sharing. And I guess given you guys worked with brokers back when you were doing deals there, did you feel like their underwriting was somewhat close to what you guys ended up actually underwriting it for, or was there a bit of a delta?
Oh, usually there's always a delta.
Was it pretty wide? I feel like people's first instinct, like everyone always wants to have great relationships with brokers, right? Because you always want to get the deal flow. But you also have to know their incentives are like to sell this thing as fast as possible. So then you're like, are these numbers actually accurate?
Well, but I actually value that because it's like sometimes the broker can give you some gunpowder and like help you see things in a different light, and like help you get bullish on something where otherwise you wouldn't have seen that and you wouldn't have had the guts to pull the trigger and put it under contract. So I appreciate that, but yeah, it's a fine line, and you have to recognize that they're very biased, and just not get emotional. Like there's always another deal. So like we've pulled, like I told you before we started the call, we've pulled out of so many deals. It's just not worth it to do a bad deal. But yeah, no, I appreciate that they try to see you help differently, and they're, I think brokers make the world go around. Without brokers, deals would not get done because they're there keeping people accountable, giving people new ideas, selling themselves and selling the property.
Absolutely. So good segue into you launching Elkstone Capital and leaving your corporate role in private equity. So can you kind of walk us through what was the motivation first for launching your own fund, and had you done deals yourself like in certain markets prior to that, or is that kind of how you started dipping your toes into it?
Yeah. So first of all, we're not a fund yet. We're just doing deal by deal right now. So just syndicating. Eventually we'd love to get to the fund model. There's definitely some pros. And no, I hadn't done deals prior to leaving my W-2. My first, while I was still at my W-2, a group approached me and they needed help capitalizing their deal. So their earnest money was hard. They had about 350 grand in earnest money hard in the deal, and they had already used an extension, and it was looking like they were going to lose the earnest money deposit. So I had done a little bit of intern work with this particular group before starting with with the church role, and so I knew them well, and anyways, I jumped on and kind of started cold calling outside of work. I just remember every Saturday, all day long, I was just dialing every morning before I went into the office, every evening, at lunch, whenever I could. And so I just hustled for 3 months and ended up helping them find the missing $7 million equity piece they needed to close. It was a $27 million purchase in Nashville, Tennessee, 207 units. And so that was my first foot in the door. I was able to co-GP on that deal through the value I created and kind of saving the deal. Um, and I think that's a great way for a lot of people to get started. Go raise for a deal. Make sure that you have a responsibility and you're not just raising capital because that's illegal. But if you do, every good sponsor is going to know they need to give you a job, so the curtain gets pulled back and you get the chance to sit on the asset management calls and start to learn. So that was my first deal.
Wow, that's pretty crazy. I feel like most people start off with like flipping homes or, doing single family. You got right into it, bringing in 7 million or somewhere in that range and helping them get this larger deal done. Can you walk us through, like, I know capital raising is so difficult for so many sponsors. Do you have a method that maybe you could share with folks? Maybe you have a process of like how you did these cold calls?
Yeah, I started with my direct network. So I just opened up my phone contact list and just started working my way down. That guy owns an electrical company in my hometown. I remember he had a nice house. He drove me around his Corvette. Let's call him. This guy was my old boss. He ran a pest control company. That was my process, is like thinking through who are the business owners who sold a company, who's invested in real estate already, because they're more likely to say yes to this than somebody who's never done it. That was my process.
I love that. You can theoretically make anyone into an investor. I feel like I've heard that in the venture world and people raise venture funds. Um, Absolutely applies to real estate as well. So super cool to hear kind of how you got into it. And we'd love to hear more about some of the other deals you've done as well. I know that was your very first one. Um, like how many have you done through Elkstone Capital since going full time? And do you focus on certain geographies or focus on partnering with certain, like how have you met your partners that you've done deals with?
Yes, we did the one in Nashville. I think I told you how I met those partners. It was through underwriting for them a little bit. Uh, did a deal with Hotel Shift in Houston. I don't know if you've heard of them. Met Alex Cartwright and his team through Best Ever Conference. It's a conference out here in Salt Lake. Speaking of which, it's coming up in about a month. You should come. It's amazing. Seriously, it's so good. It's like the best real estate conference I've ever been to. But Alex had a booth, and I met Patrick Painter, who was working with him at the time, and we were talking about this Nashville deal, and Patrick he dragged me over to the table. He's like, "You got to meet Alex. You got to meet this kid Mitch. Like he just helped fund this deal." And he was talking me up, and at the time, I still don't feel like I'm a big deal. I'm just a little fish compared to probably most of the GPs who are going to listen to this. But they're like, yeah, we should do a deal together. And they actually had a podcast boost. We ran up and just filmed a quick podcast. I never even posted it. I need to. It was a great podcast. But I just felt like our strengths and our culture kind of matched up. And I had worked with that local Utah developer that I told you about before this call that does, or maybe I told you about this on the call, the extended stay hotel to multifamily conversions. So I already knew the thesis. I already loved the concept of cap rate compression, buying these hotels at a high cap rate, selling at a low cap rate once you convert to an asset class that's much less risk, like multifamily. And yeah, they called me a couple months later and they're like, hey, come work on a deal with us. And so we purchased a 100-unit hotel in Channelview, which is a really blue collar area of Houston, right by the port. And it's going to serve truckers and people in the oil industry and energy industry. And all studios, but we'll be the cheapest in that market. So help people put a roof over their head for a cheap price, and we'll still be able to deliver an IRR in the 20s for our investors.
It's kind of nuts. I was not planning on going to Best Ever. I'm only going to Raise Master, which I think is happening next week. But maybe I'll add it. I've heard great things about it. Seems like you found partners that you're now working with
Hmm.
through it. So
Yeah.
that's always like one of the best testimonials that you can speak to. Um, and like really cool you've been able to do the conversions. I'd say like that's actually not something I know that much about. So curious, like what does that process typically entail, and how much money goes into like, per door of converting them?
Yeah, good question. Every deal is so different. So typically the process is you find an extended stay hotel, and the first thing you want to do before you waste your time underwriting and diving into the numbers is you need to call the city, and you need to figure out what's the zoning. If it doesn't allow for multifamily, will they go down the rabbit hole of granting rezone? Are they pro housing? And you can figure that out pretty quick talking to the right people. So like if they're giving me the wrong vibes on the phone, then I won't even explore it. Like I remember there was this township in Ohio. It's like Deerfield Township, and there was an awesome deal we found there. But through talking to them, I could tell, and actually it was really hard to finally get them to tell me this, but finally they just put it all out there, and they're like, look, our guys want to get reelected. None of our citizens want more housing, because the more housing we get, the closer we get to leaving township and becoming an official city, and then the tax laws change, and then quality of life goes down for everybody. And so it's just super political, and I could tell right away it was never going to happen. So not even worth going under contract, not worth stringing along that seller, because like we're very transparent with sellers. They know that if we're buying a hotel from them, we're going to need 5 to 6 months contingency to take it through planning commission and zoning commission and get the rezone on it. So that's really step one. And then sometimes, like obviously we always look for extended stay, but sometimes there'll be a hotel that doesn't have a kitchenette in it already. And yeah, then you got to go bid it out to contractors and get an idea of how much it's going to cost to plumb it and get your kitchenettes in. A lot of them don't have fire sprinklers, which that's almost always a code requirement for residential, is the fire sprinklers in each unit. So usually you have to install a fire suppression system, which is one thing we're doing at that Houston property. Another deal killer is impact fees. A lot of the times changing the use from a hotel to a more intensive use like multifamily with higher occupancy rates, the county will want impact fees to help offset the cost of extra wear and tear on the public utility system, on the transportation systems. That can easily kill a deal. Sometimes those can be in the thousands per door. And then, yeah, it's just, and then your typical value add, like how much is my flooring, my paint, my new fixtures, my new blinds. Usually you want to spruce up the amenities. For example, on that Houston property, we're knocking out some storage and laundry to add 10 more units. And that one was interesting. The balcony railings were spaced too far apart for code. So our solution to that was we're just welding an extra spindle in between each. That's how we solved that one.
That's awesome. You seem very knowledgeable about this, which is really cool to hear like firsthand. You're like very quickly can dive into the details of like the process that you're doing. Um, what is the typical timeline of like when you guys get something under contract and like you're starting that process and actually do the conversion?
Mm-hmm.
And then what do investors typically expect, like from an IRR perspective? Because yeah, I truly had not like you're one of the first people talking to that's like done this in such depth. And so for folks listening in that, want to learn more about this or want to invest in something like this, like what does that entail?
Yeah, again, it goes back to is it already, do we already have our zoning? If not, then that's gonna all of a sudden that adds 6 months to the closing process. That one in Houston, so Harris County there's no zoning. So that's why like it works really well to do these conversions there, because we don't have all that red tape. So that one was a little more straightforward from a zoning perspective, but I mean that they're an outlier, obviously. Everywhere else mostly does, and it's a 6-month process to rezone it. Sometimes like we like finding deals where the broker gives us the deal and the seller has already done that for us. Like there's one I just got from a broker this week. And that makes it easier on the seller. It makes it easier on us. The seller's going to get a little bit better of a price because they de-risk that for us. but yeah, and then closing, typical closing period. And then from the time we close, usually we'll have a bridge loan for an 18-month term with a 6-month extension. And, the goal is to get the conversion done within 12 months so that we can get out of that even sooner. But it's always good to have the flexibility, and especially because refinancing can take a long time, especially if you're going like the HUD route or the GSE route. You want to have ample time for your refinance. So, but yeah, it's not atypical to be able to do 15 units per month, but usually we try to underwrite 7 to 10 that we're turning each month.
Got it. No, it makes a lot of sense. And curious, like, given you guys take bridge loan when you're doing this, and like there, I'm sure a good amount of contingencies in it. How has like this market environment with these high interest rates and like maybe hotels and sellers in general not wanting to come down to certain price points, like how has that impacted your business and like doing more deals like this?
Yeah, obviously it's made it harder on everybody. One thing that we've tried to do is find seller finance deals, which typically we've gotten 200 basis points to 400 basis points lower than market on our rate. And, maybe you sacrifice some flexibility on term. But we have a deal in Idaho right now with a 5-year term on it, all interest only, 4.5% interest at like 81% loan to value. So like that's just as good as you could get anywhere else, if not better. So seller finance is one thing we've looked for. Not all family offices like it. I'm learning that right now. I just had a family office shut me down because they're like, we don't like seller finance. And they were one person removed from me, so I couldn't get feedback. I desperately want to know, like, okay, why? So that's one thing I'm trying to figure out. But I think seller finance is a good way to make deals happen. That's how we got that 100-unit Houston hotel done. We actually got 50% LTV on that one, seller finance. What else did you ask?
So was really just trying to see like what you guys are doing to make some of these deals work given this market environment. So it sounds like a lot of creative financing options. One of the biggest ones being seller finance. And we've had a lot of folks on the show that have talked about how they've been leveraging a lot of seller financing to make deals work. Do you feel like it's almost a requirement in this market or something close to it to make deals pencil at the moment?
No, I don't think it's a requirement. There's markets where you can go get a high enough cap rate to where, you're hopefully you're still positive leverage and you're originating new debt, or you're close and you'll be positive leverage once you're done with turning your units and your value add plan. So yeah, if we can't get seller finance, then that's the play. It's like, okay, we have to go buy something at a 6 cap or above, to at least have a decent average cash on cash over the hold period.
Yeah, no, it makes sense. I guess looking back on all the deals you've done in the pretty short period of time, that you've been doing this full time, any mistakes you made along the way that you learned from that maybe you can share with our audience of like, oh my gosh, this thing blew up, but like it taught us like to always look out for this.
Yeah, I'll share one on the capital raising front. So was working with a really big investor recently. He showed me his money market account, 70 million. So he's super liquid. And I wouldn't say we got greedy. Like, it was one of those things where communication was tough. And I sent a model, and, I had a placeholder in there for what pref we were going to offer, what the hurdles were, what the splits were. And, he saw kind of our total promote over the 10-year hold, and he just couldn't fathom like us making that much money, off his equity. And he was struggling to understand the difference between property management and asset management. I remember he asked, who's the property management on this? And it's not Elkstone. We're not a property management company. We were hiring the best in market property manager in that market. And they were like, well, why do we need you? if we could just hire this property manager and do it ourselves. I explained to him the difference. And one thing I explained, and I like to explain this, is for a property manager, we're paying the payroll, so we're paying their employees, and then typically, or at least on this deal, it was a 3% management fee. This example I gave him is if the property manager increases that NOI by 100,000 in a year, that's only $3,000 for them. Like, the marginal difference in their business is nothing. But for us, cap that at a 5.5% cap rate, that's a $1.8 million difference in value for the seller. So that's what I tried to explain to him. And then also, I think just seeing the model that we had sent pre-populated, he thought that was our offer. He thought that's what we needed to make it happen. And then he just fixated on that. And I kept saying, look, it's negotiable. Let us know what you need to be happy. Like, let's find a win-win here. And I kept giving him the opportunity to come back and give us a number, and he never did. And I came down twice on our promote, and then they just kind of said they were out, and we didn't really hear their feedback. So, I've been giving it time to kind of sizzle down or like cool down. But I still plan to approach him and just say, hey, what went wrong? Like, tell me how we can improve. Tell me, we would love your feedback and know how to better work with you next time. So like, that's a mistake I feel like we made. I'm still trying to figure out how we could have managed expectations better, or showed our value better. So I'm making mistakes all the time.
Yeah, and I feel like that's such an applicable story for probably so many folks that are in the capital raising side in this business, where like I feel like this industry has a standard for how much asset managers make for on their promotes, on their waterfalls. Like there's almost a cookie cutter at this point. Of course, like if it fluctuates based on experience, based on like how good the deal is and a lot of different things, but there is kind of like a template a lot of folks use. But if you're educating someone for the first time in some of these things, it can feel like that's huge or like this doesn't make sense. So yeah, I think that's a really good lesson for you and for anyone listening in on capital raising of like how you frame certain pieces when you're first sharing with an investor. Really, you know, first impressions are everything when it comes to fees and like how they're thinking about it. So appreciate you sharing that and kind of, what you took away from it moving forward.
Yeah.
Um, yeah. So here's for you, we've been talking about some of the deals you've already been doing, what you were doing before this. Curious what the rest of 2025 and 2026 looks like for you. I'd say 2023 and 2024 are pretty slow from a deal making perspective. I think a lot of people are excited for this year, next year. So curious, where you're at, and if everything goes right, like, what type of deals are you investing in? How many are you guys doing? Anything you want to share from that lens?
Yeah, by the end of the year, the goal is to have 1,000 doors, whether by co-GP or, we're the main sponsor. So right now that number is 437. So got our work set out for us. So, I'd prefer to do the rest in 2 to 3 really good deals. My long-term goals, I want Elkstone Capital to be at $1 billion in assets under management by 2035. I think we need to be at $300 million by 2030. So like every year counts. Like scaling a real estate private equity business takes time. But yeah, I think that's the goal this year, is to do at least 2 to 3 really good sized deals. And we're building out a team to do it. I just brought on an analyst last month, Morgan Menlove. He's been awesome. We're bringing on an intern this week, and then a second intern the following week. So, and then, I've hired an assistant. I also have an investor relations person. So the team's finally starting coming together. Last year I was kind of just a lone buck trying to make things happen. And I realized that was totally unsustainable. You can't do everything on your own. There's just too much to do. And so kind of taking a step back, training people and figuring out how to take this to the next level.
Really ambitious plans. I love that. We have also like incredibly high targets for our own company, Home Base. So I love that we share incredibly large milestones. I guess looking back in your own career now, like really just two more questions for you, Mitch. The first one being like any advice you would give, your prior self when you're first getting started or when you're first getting into real estate. And then my second question, and take it in whichever order you'd like, is just like the general real estate market. Are you bullish, bearish? There's a lot of good things in the horizon, but there's also, you know, things that are a bit still uncertain. So curious in your take.
Yeah, sorry. When you asked the second question, I forgot the first.
Oh, the first, just like any advice you'd give people first starting off.
Okay. Um,
You can probably just start with the second one first, and then I'll re-ask the last one. And I'll just cut this. I
okay.
realized that I wanted to ask you that, and then as I was asking the first question,
Okay, you're good. Okay, so ask the second question now one more time.
yeah, I'll ask it again, and I'll cut everything in the middle. But
Okay.
very curious on your take on like the overall real estate market. It could either be like in your local markets or just like the general. We were talking earlier how things have been slow the last few years. People are getting excited, but curious on your take. And are you bullish, bearish, or like cautiously optimistic?
Yeah, cautiously bullish. uh, I mean, our focus is mostly residential, and so I think multifamily is very recession proof. People always need a roof over their heads, so even if crap hits the fan, the economy, gets into deep water, people still will need a place to live, and rents could suffer, yes, but I think multifamily is going to be less volatile than everything else. So yeah, we're not afraid to be deploying capital right now, and nobody has a crystal ball. Maybe the market crashes in 6 months, and but that's why we stress test our deals. We run sensitivities. Try not to do floating rate debt. If we are, we have a rate cap, and we know where our break even occupancy is. And we understand the return risk profile of the deal. So, but yeah, no, I think there's a ton of opportunities coming in the non-performing loan space. I like just in the past week, I've talked to 3 brokers on 3 different deals that the property is in receivership with the lender, and it's either going to go to auction or they're trying to find a workout, and that creates opportunities for buyers to come in and get a better basis, get a really good deal, if they're ready, and they have the capital. So yeah, there's a lot of distressed properties, distressed owners, sellers, non-performing loans, and I think that's going to be one of the biggest opportunities over the next 12 months. And I mean, I keep hearing this from brokers in my backyard here in Utah. Next 12 months is the best opportunity to buy in the next 5 to 10 years. And I kind of believe them. Again, they're biased, but I really do think this is a good time before, maybe rates do come back down and cap rates just compress again. And we're back to pre-COVID where multifamily cap rates were in the 3s and 4s across the board, which was insane. So I'd rather buy now if I can get, a 5 to 6 cap, and ride it out.
Oh, I appreciate the take. Yeah, 3% caps was kind of an insane time. 2021, it felt like it was really hard to win deals, even if you were asking or like bidding way over ask, which
Yep.
in hindsight, crazy.
Yeah.
Uh,
Absurd.
well, to end it off, Mitch, really would love to, reflect on your career and reflecting on your time both in real estate, but also back when you're in the corporate role. Any advice you wish you could give yourself or anyone listening in that's either first starting in real estate or first starting in their career?
I love the way I did it. I think, I'd recommend it to anybody. Go, study finance at school, get out of school, do the internships, go work for a really renowned firm, get a lot of reps. The way I approached my corporate real estate private equity experience was a glorified internship. Like I get to keep learning on somebody else's dime, put food on the table and just keep getting reps and learning as much as I can. And that was my approach. And, I had enough savings, and when I felt confident and ready, then I took the jump. And you need to, if you're jumping into this space, you need to have a year worth of savings, if not 2, to be able to do this. Because you'll go months without doing a deal, and you'll get really close. You'll be at the 1 yard line on pulling off a $8 million deal just to have it fall through for some random reason. And it was 300 hours of work of your life. And it's just, there's nothing to show for it, but experience and resilience. You get back up and keep doing it. And so, yeah, no, I wouldn't have done it any differently. And I think, you know, maybe you're older and you want to get in this space, go take a course. Like I recommend everybody learn how to underwrite first, because you're just not going to thrive in this business unless you understand the numbers. So take a course, figure out how to underwrite, or get good at something, whether it's maybe you're good at asset managing, you have property management experience. Maybe you have a lot of high net worth connections through your another business you've done. Go raise capital. Or maybe you're a high net worth person, bring earnest money deposit to a deal, or sign on a loan, or bring the due diligence costs. Like those 3 ways I just mentioned are ways that we love to have people co-GP with us. And we give them a piece of the pie for offering that value. So there's a lot of ways to get into it. I wouldn't have done it any differently. I've loved my career trajectory so far.
That's awesome. I love that advice. Can't tell you how many sponsors I've met who don't have a good understanding of underwriting, which is kind of crazy if you're like doing this as a business. So that's great advice. Like people should always start there, no matter what role you take on. You should know the numbers.
Yep, you have to.
Absolutely. So that's all the questions I had for you, Mitch. Thank you so much for coming on Groundbreakers and sharing your story. For anyone interested in learning more about Elkstone Capital Partners or you, where can they find you and reach out?
Send me a message on LinkedIn if you listen to this. That's my only ask. I just want to know if you listen to this, and let's connect.
Absolutely. Any final thoughts you want to share with our listeners?
Yeah, there's no growth in the comfort zone, and there's no comfort in the growth zone. That's my favorite quote. So if you're at a point in your life where you're coasting, like raise the bar. There's a lot of joy in doing hard things and a lot of accomplishment. And the reason syndication is so cool is because it can launch your net worth and your investors' net worth and get you to a place where then you can chase your passion projects and go help other people become wealthy. So I think that is the end game here. Because like you talk to most billionaires and they become that rich, but they can't even use all that money. So I think help people on the way, get out of your comfort zone, make sure you have a strong why, and that'll propel you through the hard things that you have to do.
I love that. That's a great note to end it on. Thank you, everyone, for listening to another episode of Groundbreakers. We drop episodes every week, and we'll continue to have awesome guests like Mitch share their stories. Thank you again for coming on.
Thanks.